Hello everyone, let us look at the next chapter, chapter number 4, Intangible Assets. In this chapter, we are going to learn what are intangible assets, how do we recognize them, what is the accounting principle that we need to follow, and how do we de-recognize an intangible assets. And we are also going to look at something that we have already learned in the primary classes, like the financial accounting subject, which is the internally generated intangible assets, mainly your research and development cost. However, in this chapter, your consolidation chapter is linked to this chapter where you will be learning about goodwill and how do we account for goodwill and what are even the amortization concept of intangible assets. So let us take a look at them. So let us try to understand what are intangible assets. What is the definition of an intangible asset? An intangible asset is a non-monetary asset without a physical substance. So a physical substance means you cannot see or touch it. So let us try to understand the definition. So definition of intangible asset. An intangible asset is an identifiable non-monetary asset without a physical substance. So an intangible asset, the definition of an intangible asset is an identifiable non-monetary asset without a physical substance. So physical substance is pretty clear. It means it cannot be seen or touched. It doesn't have any physical presence. You cannot see it, neither you cannot touch it. So an asset where you cannot see it or touch it. Now, how can there be an asset which you cannot see or touch it but still call it as an asset? Now, an asset, as per the definition of an asset, is something that you incur as a result of a past event and you generate future economic benefits and you have a control over the asset. That's the definition of an asset. And you would have already learned this in your lower classes. So, an intangible asset, it is not necessary or it is not specifically written anywhere that an asset should always be tangible in nature. You can call an asset if it meets the definition of where you can control the asset, where you have, so you can say control, where you're going to generate future economic benefit, and it is arising due to a past event. So examples of assets are, as we said in the last class, or as we discussed in the last class, is any tangible asset like buildings, furniture, fittings, machineries, etc. An intangible asset are those assets which does not have a physical presence, unlike tangible assets, but they have to be two categories in intangible assets to be called as an asset. Is that they should be identifiable and they should be non-monetary in nature. All tangible assets are non-monetary in nature because it doesn't generate money. It doesn't have backing of money in it. To give an example, cash and receivables are monetary assets. Whereas tangible assets like property, plant and equipment, inventories are non-monetaries. Right? So let us try to understand these two definitions of identifiable and monetary assets. So what do you call or how do you mention an asset as identifiable? What is identifiable? So an asset is identifiable. So you can say is identifiable if there are two conditions. One is they are separable in nature, or it arises it arises from a contractual or other legal rights. So an asset can be mentioned, or an intangible asset can be mentioned as either separable or if it arises from a contractual or other legal rights. So an intangible asset should be called as separable if you have the capability, so you are capable of selling it separately and able to divide it or separate it from an entity, asset, or liability. So an intangible asset is identified as separable if you have the capability of selling it separately and you're able to divide it or separate it completely from an entity or an asset and a liability. Now we can take an example here. Let us say that you have an intangible asset. Let's say that you buy a laptop. So you buy a laptop. When you buy a laptop, you get either a Windows or a Mac software. So if you're buying an Apple laptop, then you get a Mac software. If you're buying a Windows or generated laptop, then you get a Windows software. Now the laptop is useless without the software. So the software and the laptop cannot be separated. So when you buy a laptop, when you get a free Windows software or you get an add-on Windows software, you cannot classify the Windows software as an intangible asset. As you cannot separate it. So the laptop and your software, you cannot separate it. It is one single item. So when you buy a laptop, let's say you might pay, the amount is embedded, the Windows software amount is embedded in the laptop price, but you cannot separate the Windows software and capitalize it as an intangible asset. However, let us say that you buy an additional software. Let us to give you an example, the MS Office. So an MS Office you pay, let's say, around $10 to buy the software. Then this is a separate asset. Now this software which you buy can be recorded as an intangible asset because it is separable in nature. You can function the laptop without the software. And the software is separated and sold separately apart from the laptop or the Windows software that you're gonna buy. So that is what a separable talks about, where an intangible asset has to be separated from an entity or an asset or a liability, and it has the capability to be sold separately compared to without in combination with any other asset. The second thing is, or it arises from a contractual or other legal rights. What are the examples? Any given examples? Trademarks. So trademarks is a contract. You enter with your legal proceedings, or it's a legal right to use your brand name. You have copyrights. You can use this copyrights. You have your website domain address, website domains, which you buy with a contract and register your website for this particular domain, and that can be classified as an intangible asset. So anything that arises from a contractual or another legal rights with another legal rights will be classified as an intangible asset. Also, you can talk about, franchisee agreements, right? Where you are a franchisor and you give franchisee agreements to your franchisees. So those can be classified as an intangible asset because you're generating revenue out of it. You give your trademarks license or you give your intellectual property rights to use it to any other entity and generate revenue out of it. So all those things where you enter into a contract or it arises through a legal rights can be classified as an intangible asset. Now let us look at the next one, which is monetary. So what are monetary assets? So monetary assets are money held and assets to be received in fixed or determinable amounts of money. So monetary assets are nothing but money held and assets to be received in fixed or determinable amounts of money. So either you're holding a money, holding money and you receive in return only money. So that is called as monetary assets. Now, what are the examples of monetary assets? Your cash, trade receivables, your bank accounts, all these are your monetary assets. And they do not, so monetary assets do not meet the criteria of intangible assets. So they are not intangible assets. PPE, property, plant and equipment, are non-monetary, but they have physical presence. So even PPE or your inventories are not intangible assets. So even them are not intangible assets. However, your computer softwares, as we discussed, trademarks, etc., are non-monetary in nature, and have no physical presence. So these will be your intangible assets. So what are monetary assets? Plain and simple, they are money that you are holding it and where you are going to get or receive in return money for those assets itself. So liquid cash or any trade receivables are your monetary assets, and all other assets like PPE or inventories are non-monetary assets. The next topic that we're going to learn for intangible asset is the recognition criteria. So how do we recognize, or when do we recognize an intangible asset? So intangible asset can be recognized when A, it is probable that future economic benefits will flow to the entity. And second is that the cost of the asset can be measured reliably. So the cost can be measured reliably. So if these two conditions are met, then you can recognize the intangible asset. So the standard that we follow for intangible asset is, for IFRS, is IAS 38. And this is mentioned in IAS 38 para 21. Now, intangible assets can be recognized in two ways. One is that they are acquired separately, or acquired, I can call it as acquired intangible assets. And then there is something called as internally generated intangible assets. Internally generated intangible assets. So you can recognize intangible assets in two ways. One is that you are acquiring it, you are buying it. And you can buy it in two ways, or you can enter or get an intangible asset in two ways by buying it. One is that you are acquiring it separately, or through a business combination. Acquired as part of business combination. So an example for an intangible asset that is acquired separately is a computer software. An intangible asset that is acquired as part of a business combination, an example is goodwill. So this will be goodwill, and this example is software. Now there is another portion which is called as internally generated intangible assets. Internally generated intangible assets. So an internally generated intangible asset has to meet a recognition criteria that is established by IAS 38. And as per the standard, any internally generated brands or goodwill cannot be recognized or cannot be classified as an asset. Only internally generated intangible assets, which are R&D cost, research and development, or specifically development cost that meets a specific set of criteria, can be classified as an intangible asset. So it is not common, or it is not easy to classify an intangible asset that is internally generated. So only development cost that meet the criteria, and the criteria is pi rate. So only the development cost that meets the pi rate criteria can be classified as an intangible asset. So if the pi rate condition is not met, then you cannot classify or recognize an intangible asset. So you have to be very careful. Items like brand, internally generated brand, customer reviews, or goodwill cannot be classified as an intangible asset. So be very careful when a question is being asked on this particular area. Alright. Now let us talk more in the case of goodwill and a business combination. Intangible assets that's acquired through business combination. So I'm going to talk about business combination. So what is a business combination? A business combination is where there is one entity acquires another entity as a whole. Another entity as a whole, or you can also acquire partly, but the entity one has control over the acquired entity. So to give you an example, let's say you have a P company. Now if P company owns S company's more than 50% share, then it is said that P company controls S company. Now, how does a goodwill arise in this particular condition? Now, a goodwill will arise when let's say that you are acquiring P company. To give you an ease of access, let's say that you are acquiring P company is acquiring 100% of S company. Now, as per S company's books, which is your which is your equity value, or you can say the book value is, let's say, is around 100 million. Now, P company is trying to acquire S company, and they give an offer to S company stating that I'll give you 100 million and I'm buying your entire company. But S company has the capability to reject the proposal, because you know that you are running in business for more than 10 years. So let's say that you are in business for more than 10 years. Now, if you are a company that's running for more than 10 years, you should have certain amount of goodwill, isn't it? You would have created your own customer profiles. You would have created your own business brand, etc. So, when P company gives an offer of 100 million, S company rejects it. Now, what happens is that P company now comes up with a new offer. So, let's say that, the new offer price is $120 million, which is 20 million greater than the equity value of the company. So you are paying more than what is left in the company. So what does equity comprise of? Since you are learning FR, you should be knowing all this. So equity means your net assets. And what are net assets? What is the residual balance that is left in the company, which is nothing but your total assets minus total liabilities. Your net assets is equal to your equity, which comprises of share capital, share premium, retained earnings, revaluation surplus, etc. So the entire equity portion of your business is called as your net assets or equity value. Now, as per your books, you have a net assets of 100 million. Now, P company is ready to pay 120 million. So, the extra amount more than your equity value or net assets will become your goodwill. So, your goodwill is nothing but extra amount greater than the net assets or equity value of the business. So in this case, 120 million minus 100 million, the extra 20 million will be the goodwill. Now you can ask, since the company is there for 10 years, why can't they expect, or why can't they show the 20 million calculated amount by S company itself as goodwill? No, that's not possible. Why? Because goodwill is always changing. Number one. Second thing is, when you acquire a goodwill, when you internally generate a goodwill, the problem is that there could be a lot of miscalculation. Like there is a lot of estimation involved. You don't know what your company is actually worth until and unless you are being sold off. Let us say if the offer was 110 million and still S company's owners, the shareholders, agreed for the 110 million, the goodwill would have been 10 million instead of 20 million. If even after offering 120 million, if the S company, the shareholders of S company, do not accept the offer price, and P company in turn increases their bidding to 140 million, then the goodwill will become 40 million. So it is very difficult to estimate or calculate what is the goodwill of the company, the brand of the company, because it's always changing in nature. Second thing is that one small thing can spark off the goodwill and create a lot of reduction in the value of the goodwill. So because there is a lot of ambiguity around, internally generated goodwill are not recognized or categorized as a intangible asset. So this is very important. So if the goodwill is internally generated, then you do not recognize. Do not recognize. But if the goodwill is acquired via business combination, then you recognize it. So, recognize as intangible asset. So, what assets which are internally generated can be recognized as an intangible asset? So, let us look at that as a next topic. So, in this topic, we are going to learn what are internally generated intangible asset. For this, let us take an example. We have all gone through the phase of COVID or coronavirus, which is called as the COVID-19. Now, when the COVID-19 initially occurred, there was no vaccinations, but there was a company, a pharma company, that came up with a formula or came up with vaccinations. So they generated vaccines for COVID. Now, when you generate a vaccine or when you generate or manufacture a medicine, it is not an easy process. It goes through a lot of research and development. So anything that you generate actually goes through two phases. One is a research phase, and then there is a development phase. A research phase is nothing but where you are in the initial stages, where you understand what is the symptoms of COVID, where you understand what is the formula for COVID, how you can tackle them, what is the chemical formula that you need to use to develop the vaccines, and you do a lot of research on it, involve your scientists, talk to them, take discussions, and come up with a research part of it. The development phase is where you are starting to develop it, where you have a way ahead, where you have a go ahead. Research phase is still where you don't have any way forward, where you are still at the stage that you can develop it and you can materialize it, or you cannot develop it and it will be a failure. So research phase, the vaccine can, when a vaccine is in the research phase, it can go either ways. It can materialize and become a vaccination, or it cannot materialize, because you're still trying to understand what is the benefits and what is the expense you require. A lot of things. There is a lot of questions in your mind, and you do not have a fixed plan, or you're just going there and finding out, okay, what if I develop the vaccine? What will happen? You're still trying to understand what is going around it. So the standard says that when you are in the research phase, the entire cost that you spend, so cost for research or expenses that you spend, should not be capitalized, should not be an intangible asset. Rather, it will be expensed off. To where? To your profit or loss account. So any amount of money that you spend for your research phase will be expensed off to your P&L, and it cannot be capitalized or recognized as an intangible asset. So what can you recognize as an intangible asset? And that will be your development phase. Now, even in your development phase, there is a criteria that you need to follow to start capitalizing your intangible asset, or start recognizing your intangible asset. Because as I said, when you are in the research phase, let's say that you have now a way formula. So way ahead, you have done your research, you have come up with the formula and you have decided to develop it. But in the initial stages of development, you put in a lot of money. While you are going through the midway of where you are almost there and you test your trial runs or you start your trials, there was a lot of symptoms because of the vaccine. Now you have to start all over again. You have to change your formula. You have to incur a lot of expense for that as well. So, because of there is a lot of ambiguity whether the product, even after developing it, whether it has to go through a lot of trial runs and you don't know what is happening, whether the product will be a successful product or not. There is still a lot of confusions. IS 38 says that you can recognize the intangible asset or capitalize the development expense only if it meets the following criteria, and the criteria is called as PIRATE. So only if the intangible assets meet this criteria or all of this criteria, you can recognize it as a intangible asset. Now, PIRATE full form is P stands for probable. So you are probable that there will be future economic benefits. So there will be future economic benefits that you can generate from this particular development. So once you develop the vaccines, you can sell the vaccines and you can generate money out of it. So there is a probability that you will make money out of this intangible asset. I stands for intention to complete. You should have every intention to complete and use or sell this asset. So you can either use that asset in your own business or you can sell it off and make money out of it. But you have every intentions to complete this particular intangible asset. The third thing is you have adequate resources. So adequate resources. So let us say that you are developing a teleportal machine. You know that you have probable future economic benefits. You know that once you develop this teleporting machine, you can generate the money by creating a trademark for this particular machine, and you can generate money by patenting this particular machine. You have every intention to use or sell the machines, or you can use the patents to generate money itself, but you don't have adequate resources. Nobody knows how to generate this machine, so you don't have the resources enough. Or another case is, let us say that in the same case of this vaccination, you have the intention and probable of, that there will be probable economic benefits, but you don't have enough employees to manufacture those machines. You don't have enough money left. There is nobody to invest in your formula. Even then, you cannot capitalize it at that point in time. The fourth thing is ability. Ability to sell or use. Now, you should be the person who is capable of using it or selling it. Like someone else is developing the asset and you are using it, then you cannot capitalize the intangible asset. Let us say you are developing this particular vaccines for the government of India, then the government of India owns the rights, the patents or the trademarks for this particular vaccinations. But if, to give you an example, another example is, the private companies that develop these vaccines, right? So these vaccinations which the private companies develop, they are selling it by themselves. And they have the ability to use this particular asset and sell this asset. And hence, they are the ones who have the exclusive right to use it or sell it. And they are not developing it for someone else. But if a company outsourced the capability to someone else, then the outsourced company cannot generate as an intangible asset, but the company who owns the formula or the company who's paying for you to outsource them and to develop them, then they have the ability to capitalize this asset. The fifth thing is very simple, which is called as technology. You should have enough technology in place to develop it. You cannot just simply, develop something which is way ahead in the future. To give you an example, flying cars. You know what is the physics behind it. You know what is the energy consumption that is needed, but you just don't have the technology to build something. Then finally, you should be able to measure the expenditure reliably. Should be measured reliably. So only if you are able to measure this expenditure reliably, you can capitalize the intangible asset. So hence, all the research expenses will not be recognized and will be expensed off. If all the criteria are met, so all criteria met, if the criteria are met, yes, then you can recognize as intangible asset. But if they can't be recognized, if the criteria are not met, then it has to be expensed off and you cannot recognize it. So it is very important that even if for research and development cost, all research expenses are to be expensed off, but development expenses only if the condition of pi rate, all the six conditions are met, only then you can recognize it. Even if one condition is not met, they have to be expensed off. And that is very important for your intangible asset. Now let us say, understand how do we measure them. Measurement comes in two ways. One is an initial measurement. So initial measurement is when you initially incur the cost or when you initially purchase it, how will you measure it? So as we know that intangible assets are of three categories. One is that intangible asset that is acquired separately. So intangible asset acquired separately, like your softwares or the legal rights and all those stuff. The second is acquired via business combination. Which is goodwill or brand or brand marks or customer satisfactions and all those stuff. So which you acquire or you get it as part of acquiring a subsidiary. And the third point is internally generated intangible asset. So any asset that you generate internally, how do you measure it? So any intangible asset that you acquire separately are measured at cost initially, and your cost will be your purchase price and any directly attributable cost. Any directly attributable cost. So let's say that you buy a software and you pay let's say $10 to acquire that particular software and you pay $2 for taxes, then your total will be $12. So the $12 will be the cost. Now for your business combinations, your business combination should be measured at fair value. So measured at fair value. And we will talk about this when we actually learn the consolidation chapter. So I'm going to pause that for here and just stop it there, that any intangible asset that we acquire using business combinations will be measured at fair value. Internally generated will also be measured at cost. Now the cost will be the expenditure, sum of expenses that you incur, sum of expenses incurred while developing the intangible asset, which is your development cost. The expenses that you spent to develop that asset will be your sum of expenses, and also any directly attributable cost. So any other cost which you can measure or link it directly to the expenditure or this intangible asset will be or can be capitalized together with the expenses of the intangible asset. So this is your initial measurement. What about your subsequent measurement? So your subsequent measurement. So subsequent measurements, you follow similar to that of your tangible non-current assets. You follow two routes. One is that you follow a cost model. You follow a cost model, or you can follow a revaluation model. So a cost model or a revaluation model. So a cost model is nothing but your cost minus accumulated depreciation. In intangible asset, we call it as amortization. So your depreciation in intangible assets or for intangible assets will be called as amortization. So any cost, which is your purchase price or your expenses incurred and any directly attributable cost added together will be reduced for your accumulated amortization, which is nothing but your total cost divided by your useful life of the asset. For revaluation model, you need to follow two things. One is whether there is a active market. So if there is no active market, then you can only follow the cost model. If there is an active market, you can fair value. You can fair value the assets. So fair value the assets to revalued amount. So similar to that of your non-current assets, but in non-current assets generally will have an active market, but for intangible assets we need to ask a question whether the intangible asset has an active market or not. Let us say that you have a trademark, a brand name which has been lying there for 10 years, or a trademark on that name which is lying there for 10 years, but nobody is there to buy that particular trademark. So there is no active market. So you have to use the cost model completely, because there is nobody to buy that particular name. But if there is an active market, there is a unique name and people are willing to pay any price to buy that particular name which you have trademarked, then you can use a revalued model. Another example is copyrights or patents. You have developed a formula where let's say you have developed a code, an IT application code, and you can sell it off so that anybody can develop that particular similar application, but if there is no active market for it, there are no much users for it, or no much users for the code, there is a better code that is available, people will go for that. So in this case, there is no active market. If there is no active market, you cannot use a revaluation because you don't have the fair value. You cannot arrive at the fair value. So you need to use the cost model. So the accounting for revaluation is similar to that of your tangible assets, where you will use, where there is an increase in value. So when in revaluation, there is an increase in value, so let us say that there is an increase in value. You debit the assets and credit revaluation surplus. And in case of decrease, you debit your revaluation surplus, that goes to OCI, debit your P&L, which is your decrease in excess of your revaluation surplus, and credit your assets to record the carrying amount or reduce the carrying amount of the asset. Now let us talk about how do you depreciate this particular asset. So amortization. So your amortization is nothing but your annual amortization will be nothing but cost divided by useful life. Now what is the useful life of a goodwill? It doesn't have a useful life because it runs for an indefinite useful life. Goodwill is what? Goodwill runs until the business is in the market. If you are running the business, there will be goodwill. If you stop the business, it stops. The goodwill stops, right? So goodwill will have an indefinite useful life, but there are intangible assets with a finite useful life. Let's say that you enter into a copyrights, you buy the copyrights, and the copyright is given for 5 years, there is a finite useful life. Or if the copyright is given for 100 years, there is a finite useful life. You write a book and you develop a code or write a or develop a medicine and you patent it, and the patent is given only for 50 years or 60 years, then you find useful life will be 50-60 years depending upon the how much amount of years are given. So amortization depends upon two things. One is finite useful life, and then something called as indefinite useful life. So any asset with a finite useful life will be amortized based on your cost by useful life. So, and that will be amortized. Your intangible asset will be amortized. But any asset with indefinite useful life will not be amortized. But there is a condition that every year you have to check for impairment. And what is an impairment? Impairment is a reduction in the value of the asset. So every year you have to strictly check whether the asset has been impaired or not. And that's a condition that you need to follow for an asset with an intangible asset with a indefinite useful life. You need to review the useful life at least annually, and you conduct an impairment review. So also you review the useful life annually. Useful life annually. And here, one another thing to note is, for any finite useful life, your amortization is taken into your profit or loss account, and your residual value is normally 0. You have to review the useful life. So review, even for assets, intangible assets which are with a finite useful life, you review the useful life every year. And if there is an impairment test and an impairment is identified, you impair the assets, intangible asset with finite useful life as well. It doesn't mean that you're following an amortization, there won't be any impairment. There could be an impairment. If the value of the asset has depleted significantly, it has to be impaired. But indefinite useful life will not go for amortization. You will test for the impairment every year. But an asset with finite useful life, you don't have to test it every year, but only if there is a conditions that states that there is an impairment. The last part or the last topic that we are going to discuss for intangible asset is derecognition. Derecognition, which means you're either selling it off or you have removing that particular asset from your books. So a derecognition is where maybe you you dispose it, disposal, or when no future economic benefits are expected from the use. So when you dispose or when you derecognize the asset, you calculate, similar to that of your non-current asset, your gain or loss on derecognition. And how will you calculate your gain or loss? And that is pretty simple or very easy to calculate. There's nothing but your disposal proceeds, let's say that that's X, minus your carrying amount should give you your gain or loss. Gain or loss. What will be your journal entry? You debit cash, credit intangible asset, and credit your P&L. Or you can also debit your P&L depending upon whether it is gain or loss. For any asset that actually has a revaluation model, one thing that you need to ensure is that you transfer your revaluation surplus to your retained earnings, the entire amount, once you dispose it. So you debit your revaluation surplus and credit retained earnings. Once you have disposed that particular asset, the revaluation surplus which was identified for that particular asset will be completely transferred to your retained earnings. So that's it for this chapter. We'll continue with the next chapter in the next class.